All right, so after having the biggest meeting-to-meeting return in the S&P 500 at least since August of 2009, I saw from Bespoke earlier today. Again, a long, long time, and again, coming off of that was when we were coming off of 0% interest rates. But again, the big strong meeting, the market blew away expectations today. The Fed delivered upon what the market had been pricing in over the past 30 days or so, 30 trading sessions or so, and then some. And the markets took off, especially the Russell 2000 up 3.5%. Now the question is, again, is this a breakout move? Or considering how bullish we've already been to an extreme amount, like we've already been on a parabolic move, we've seen exhaustion type rallies on the top of what's already a parabolic move. Is that the case here? Is this an exhaustion day with a move that's already been parabolic to get to just this point? So we're going to break that down. We've seen that before. We've seen plenty of examples of that before. We think that this is a uniquely bullish move that is so strong that we've never seen a market this bullish. We've seen a market this bullish quite a bit, especially really in the last 5 years. Since 2018, things have really kind of gone extreme in their moves to the upside and, of course, to the downside with COVID. But we've had multiple extreme moves to the upside. So I'm going to kind of show this rally and with today's move in context of some of these other extreme parabolic moves that we've had to see kind of what we should expect now to see going into the end of the year, which is only a couple more weeks, and into 2024. As the market, as the Federal Reserve now, those voters are now expecting rate cuts. And as many rate cuts are priced into the market next year as what you typically see during recessions. So is the Federal Reserve pricing in recession? Is the bond market pricing in a recession for 2024? We're going to break all that down. And then we're going to talk about our trade idea of the day, a stock in a sector, kind of an interesting mix of sectors that led the markets today. We'll take a look at that. But one stock within one of those sectors, kind of breaking out on its own. We'll talk about how to trade it. So let's go ahead and get started. Today is Wednesday, December the 13th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're following us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart, it opens up this tab. Hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So it's a really big deal for us. That's why we always ask for it. So thank you those who like it day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. Let's start off taking a look at the S&P 500 with the market forecast indicators. You can see another strong day today, 4,700 now, 5 days in a row to the upside, coming off of course, the FOMC meeting. 4.5% above the 30-day moving average, still above that 2.5% mark. And then, of course, the intermediate line still above 90th percentile. In fact, it's above the 99th percentile, as well as the near-term line almost at the 99th percentile. So about as strong of a rally as we can get right now. The market sentiment line is in bullish territory itself. The momentum line is also still in bullish territory. So really, really strong move coming off those two clusters, coming off those two, being that far below, which was in the lowest decile of this past year. And then, of course, not even in the upper decile. We're still only in the 85th percentile of the current range. Of course, the bigger move was the initial surge that we had that you'll see here in just a second. The big move today was in the Russell 2000, which has been, remember, the S&P is clearly above this high point. The Russell's been playing catch up here. That's why its moves have been so big coming off of the December 1st. You had the inflation report that pushed stocks higher there. You had that move on December 1st for the Russell, which was unique to just the Russell. And then now this move, finishing with a cluster. So that, again, another unique move. The Russell's up 3.5%. It's up in the 96th percentile up 8% above the 30-day moving average. Again, it's been there before over here in February. On February 2nd, we were 8 or 9%, 9.08%. We're at 8.37 right now. So it kind of gives you an idea of how strong that rally is. If you look at the NASDAQ 100, ironically, is the least bullish out of all these. It's only up 1.25%. It's only up 5% above, but you notice, which again, it's a small number for it. It's only the 64th percentile. So it's been a lot stronger before. It's not really participating as much in this move in terms of the parabolic move. But remember, it's also easily above that July peak, whereas the Russell's still barely getting above that 23rd percentile of that peak. And then finally, your Dow Jones Industrial Average, after getting a cluster a couple days ago, which was unique to the Dow, and I haven't already broken above the July peak in November, is now also in the 96th percentile, just like the Russell 2000. And again, 90 and almost 99th percentile on the intermediate line, 98th percentile on the near-term line, the momentum line there with its market sentiment also in bullish territory. So very, very strong moves above the 90th percentile for multiple weeks now, which is so rare to be. It's not rare to be in the 80th in the upper reversal zone for a long time. It is rare to be above the 90th percentile for a long time. It goes to show again the parabolic nature. We'll take a look at some of the parabolic signals that we're getting. You also notice here too, we're above that 0% retracement. That 0% retracement goes back to this high point, right? So over here, this high point of 36,952, we're at 37,000 now. We close here at 36,800. Again, we're at 37,000. So the Dow Jones is the first of the major indexes to breach that early January peak. The S&P is still slightly below it. The NASDAQ 100, if you'll notice, is also just barely below. You can see the high point here at 16,607. The highest close at 16,567. Today we close at 16,562. So we're just barely off of the highest close. And it actually had the highest peak over here at 16,764 and the highest close at 16. This would be on November 19th, 16,573. So it didn't peak in early 2022 like the S&P and the Dow did. It peaked earlier, and of course the Russell 2000 still is quite a bit of ways. I mean, as bullish as we are right now, we're nowhere even close to its November 2021 peak, and of course its peak in January of 2022 was actually lower, much lower, and we're not even close to that one either. So in fact, we are just barely breaking above that 38% retracement level of the correction, or of this post-COVID rally. We're barely back above that. It kind of goes to show again why we're getting such strong moves in the Russell, because it has been so much of a laggard compared to all the major indexes here. All right, let's take a look at the weekly chart. If we take a look here, very, very strong candle, back above the moving average slightly. Not quite back above that 3% mark, but back above the PPO, also not higher than what we saw in July, even though we are easily higher than what we're getting right now. Higher high, way higher close, and as of right now, next week will definitely be a higher close, at least starting the week with a higher close. So we've gone from what could be a potential for a reversal into a new impulse move, and we'll see how much longer this one lasts. Again, looking at the Russell 2000, which has been in this dovish, this bearish cross mode, now it's back in. Now it has a golden cross. We're using so bullish today. The 10-week exponential moving average is now crossed up above, and you can see how big the size of the candle here is, as big as we've seen. About 4% is the size of that candle there. And like I said, not quite up to that old July peak yet, but close, right above that 78%. And again, very big candles, higher, much higher high, higher close on the Russell 2000. So you can see kind of the difference. And then the Dow Jones, which has again breached up to new highs, also has the highest Hakunashi close that it's had. So it's higher Hakunashi close than what we had over here. So much higher Hakunashi close. Still a very big candle, though the average is still pretty. It's not above the average yet, and the PPO is the highest it's been during any of this rally that we've had coming off the October 2022. Still not as high as we were, but the highest it's been. So nice little move on the Dow. Your Nasdaq has been kind of trudging along here. And is also in divergence mode. As of right now, it's in divergence mode. We'll see. I remember this peak was more parabolic, so we got into the upper decile above 10%, and we'll see the Hakunashi candle is also potentially forming a divergence there as well. 3 green arrow chart has 3 green arrows again on the S&P 500, and the Nasdaq got 3 green arrows yesterday. You can see the Dow only had a couple of days without it. It's back to 3 green arrows. The Russell never stopped getting it. It didn't get 3 green arrows till late, and then it hasn't stopped. Whereas the S&P and the Nasdaq had a brief period of where the MACD was in convergence mode, and we haven't had that on any of these. And you can see the histogram, kind of like it did over here on December the 1st, picked back up again. It only picked up for a couple of days and went sideways, and we'll see how much we pick up here, since again we haven't had a red arrow yet. If you look at the 2-line version of the moving averages, again well up above that July peak, well up above the MACD is back above its moving average since the green arrow on the MACD. Though still, the histogram over here is the highest. Is really high. We're not near that peak, even though we're much higher high on that. IWM looks similar. Right, we got the surge in the histogram. A couple of surges in the histogram, and then now we're continuing up to the highest level the MACD has been since February. So kind of another nod back to this parabolic move we had back in February. They're breaking out of the value area for the 1 year, breaking out of that value area, and you can see well above. And if I were to go back to the S&P as well, if you look at how far above the 50-day simple moving average we are, take a look at this. Again, this is the highest we've been above the 50-day moving average for a few years. You go back out to a 3-year chart. So here is, again, 10.64. You can see back here in August, we were at 10% above the 50-day moving average, hitting the 200-day. We're obviously well above the 200-day now. Same thing with SPY. You can see it actually changed from the time that I initially was looking at this earlier today, up to almost 7%. And you can see again, August we were this high above the 50, and November we were this high above the 50. In both those instances, again, below the 200, well above the 200 this go around. But again, you can kind of see the kind of move we're getting is not unique, as we've had these kind of big moves before when the market has been pricing in those rate cuts. Now back here, the Fed didn't, as the Fed did today, the Fed did not back here accommodate those move, and the Fed seemed to confirm the market's pricing in those rate cuts today with what they talked about. Though I don't really understand, or really don't think the market quite understands that the Fed is pricing in. The Fed's projections, at least, are expecting 100 basis points of cuts. The Fed has never cut 100 basis points without us being in a recession, and if you look at their projections, they're projecting unemployment rate to move up significantly, and they're projecting their real GDP to be significantly lower than what we've seen here recently. So I don't know if the market really understands that the Fed is kind of starting to price themselves expect a recession for next year, and that's the reason why they're looking at rate cuts going forward. So it's kind of interesting to see how the market is not really taking that into account with how bullish we've been here lately. Now let's start taking a look at some of these oscillators. Now, this is where it gets crazy because, again, you can see how low the negative indicator is. It's below the 10th percentile. It's below the 8th percentile. I mean, that's a really, really low level. We don't get that low. It's been a long time since we've been this low on the negative. One of those times being over here when we went parabolic there. You can see that's about how high the ADX got. And then over here in 2018 when we went parabolic there, and then it broke in a big way. In fact, after that parabolic move, we were at the same level all the way over here into 2020. So over 2 years with ups and downs, but 2 years being flat after that parabolic move over here. So that's what happens when you get significant parabolic moves where the ADX takes off above 50 here, and we're probably going to end up getting above 50 since we haven't bottomed out yet or peaked on the directional movement. So it's very significant move there, and IWM is doing it too. So IWM again, the ADX now is almost at 40 at 37. You can see other instances where it did get here the reopening trade. IWM took off in a parabolic move over here in 2017. IWM, all these instances where it had underperformed for a significant chunk of time. And you can see now it has orange arrows, which you can see is even more rare for it to get orange arrows than it is, than the S&P is to get it. And you can see again after this reopen trade where it went parabolic, then it obviously went sideways for most of 2021, and then it's been way more bearish than the rest of the market throughout 2022 and 2023. So and here we are again, another parabolic move. And the ADX is not done because the ADX always peaks afterwards. It's lagging. These indicators, the directional movement index will peak first. And it finally got above 40. It's not very common, you can see, for the positive indicator to get above 40. You can see some of the other instances over here. And then over here, you can see the parabolic moves that ultimately lead to, at best, prolonged sideways moves on the but none of those, only a few of those coincided with the negative indicator being so far down at the same time. See, this one, the negative indicator was not down. This one, the negative indicator was not down. That one was. And then this one, the negative indicator wasn't down as low as it is right now. So very parabolic and from this particular indicator. Of course, you're above 8% now, which is, or at least right at 8%. On the trend quality index, you can see how far the rate of change has moved. In fact, when you look at the rate of change, that's what that red line is showing us. If I go over the last, I believe this is now 31 days. Let me check just to be sure. 32 days. If I go to the rate of change now for 32 days, including today, coming off of that October 27th low point, now we are at, I have to move this up even more, 14.32% over this amount of time. So again, if I were to zoom out a little bit here, to kind of give you an idea of other instances where we've been up this bullish, most of them have come off of lows that we've had a pretty big spike in the volatility index. Not necessarily the case this go around. Not coming off of a low point either. You can see some of these lows that we're coming off of. This low in particular, we're coming off of a 32-day low, 14.5% decline. This one was half of that, or less than half of that. So about half. So again, not nearly the same degree, and yet still the same kind of move that we've gotten off of the tremendous lows, kind of tremendous washout low points. But that's what that Ichimoku, that's what this red line showing us. So it's a 26-day rate of change. And then of course that quality index. The last time we were above 8%, you can see it was in July there. And kind of give you an idea, that black line's 8% mark. We don't get above it for very long. November before that, over here on that parabolic move. And then going into COVID, we were tremendously bullish. That's why one of the reasons why COVID was so bad. Coming off the 18, going into 2018, look how high it got over here. It was like so parabolic there. And then of course here in 2017 beginning, coming off of the 2016 election low point there. So that's what we're getting right now. So another sign. Here's another parabolic signal. You can see we're well above 70, almost 75, excuse me, almost to 78, and we almost hit 250 on this. So that's an uncommon combination for the RSI and the CCI to get to at the same level, especially for the CCI never did get above 150 for most of this bullish rally, and then now finally kind of like it's looking very much, considering again how bullish we've already been, it's looking very much like more of an exhaustion type move here on a lot of these indicators, including the RSI and the CCI. You can also see it here on the stochastics. This is the stochastics where we've closed relative to the 4-week range at the 98.8 percentile. So we're slightly off of the hot 4-week high, which is today's high. But if you look at the orange line here, let me take off the blue line here. So give me 1 second actually here. So I'm going to take off that blue line. The orange line is a 20-day average of the blue line. So the blue line is where did we close today relative to the 4-week range. The orange line is the 20-day average of that. So the orange line's at the 95th percentile right now. So in other words, over the last 20 days, we've averaged closing at the 95th percentile of the 4-week range. That's a high number. That's what the blue line is representing there. You can see it's not common to get this far above. It's especially not common to be there. Like we've been above, we first hit the 95th percentile on December the 1st. So it's now been 2 weeks, nearly 2 weeks that we've closed on average over 4 weeks at the 95th percentile of the 4-week range. That's a strong, way overextended move to the upside. You can see very uncommon. Even the August move over here barely got above the 90th percentile for just a few days before rolling over. And this peak over here in March eventually got to the 80th percentile for a few days. So to be above the 80th for as much as we've had, and to be above the 90th for as much as we've had, it kind of goes to show just how strong this move has been to the upside. Looking at another indicator to look at is, not the Ichimoku cloud, the Bollinger Bands. Here's the other exhaustion type move. We hit 128% above the upper Bollinger Band today. Again, you can see over the past year, that's the highest move. In fact, over the past 3 years, when you look at this up and down and then back up move, it's the highest we've never cleared. We've only cleared 105 or 114% of this level, about 115% a couple of other times. Of course, we're at the 128th% mark, way up above the Keltner channel. One of the bigger moves above the Keltner channels we've seen, again, since some of these other exhaustion type moves that we saw in mid-June and then late in early February there. And if I were to go back a few years for some more examples of getting far above, and you can see how big the momentum peak was. You can see we barely got above the Keltner channel a little bit there. We never did really have an exhaustion type move like we get right now. But again, it goes to show just how big of a move this has been. We've already had the big momentum peak, kind of similar to what we had here. This was actually right on that level. But we've had the big momentum peak. And then after that peak, with the Bollinger Bands nearly inside the Keltner channels, we explode up to the upside. Very much an exhaustion type move. When you look at the 4-week range, you can see how much we've actually increased. In fact, you can see the 4-week channel increased up here because we pushed the 4-week high up to a high level, so high that, again, we're that far above the value area and we're way up above the point of control. And you can see that we're going to move up that low point up to this level, and then eventually by next week we'll be up here at 452. So remember how we moved up to 4-week low quite a bit. Well, now we've moved up the 4-week high. In the past 2 days, we moved up the 4-week high 10 points. We moved it up 12 points and we're to get to this point, and we're going to move it up about another 8 points to get up here, 6 points to move up into that level. So if I were to show you now the linear regression for that 4-week channel, again, as you get to these smaller time frames, it gets a lot tougher to get outside of these upper standard deviation levels. Let's see here. Let me get rid of this extended hours trading. So here we are now into a 4-week range where it's really easy just to stay along the channel. And then now you can see with the amount of volume we've gotten today, big volume to the upside, we broke out in a big way to the 2-second standard deviation channel of the 4-week range. So big move there, obviously having a big impact on volume. It's one of the bigger volume days we've had in a while, going back to really the CPI report was the last day we've had this much volume, and before that, these moves. Also had a tremendous range today, almost double the average. So when you look at the range and the volume was in the 90s, so well above the average. And then the range, you can see the ATR got back above 4% with a almost 6 and 2/3 point move today. So quite the move that we're getting there. And then let's look at the volatility index. So you'd think, okay, well, the volatility index dropped significantly. Nope. It dropped yesterday down below 12, started to ramp up, got back above 12 barely by the close yesterday. The VIX rallied today. So the VIX, instead of dropping significantly, actually stayed higher. It did get to extreme lows yesterday intraday, almost to that 80% low. And you can see the other thing is the VIX dropped to 80. It got another 80 handle. Again, that's an extreme low. We've gotten the below 75 a couple of times that preceded some increases in volatility there, and a big increase in volatility here in March. And you can see the last time we were at right around 80, right below 80. It preceded that increase in volatility that we saw. And the VIX itself, when you look at the VIX, remember the reason why it can't go down is because it's already pretty significantly below some of these levels, its average levels. It's going to start limiting the downside because of how already low it is. So we'll keep an eye, especially with the VVIX being as low as it is. We'll keep an eye on that VIX with it, being right around 80, and the fact that we jumped up so much today with the VIX not falling kind of makes you wonder about the downside of the VIX and potential upside, as we've seen on other instances where we've also been extremely low. You can see back over here in early September, the VIX here got down right there. Got down to 13 and got below the 85th percentile or 85% mark, versus the VIX 3M. And then, like I said, you ended up with this pretty significant rally because of how extremely low we were. And we're kind of to that same point again today. All right, let's go ahead and take a look now at what's driving. Of course, we know what's driving a lot of this price action. And again, look at the 3 months. So the Nasdaq's up 8%, over 3 months. That was after at one point being down almost 8% over this time frame. Again, the 3-month period starting back in September. So that's a pretty decent move. And commodities, interestingly enough, did not really ramp up hard today, not nearly as much as like the equity markets did. And the real estate market, you can see, really took off today too. And gold, with the dollar dropping sharply, yields dropping sharply, so bonds rallied higher. And of course, commodities. Bonds making the biggest move, a big move. It's made a tremendous move to the upside, along with equities. It's almost reached its 200-day moving average after bottoming out here in October. It bottomed out about a week before the equity market started to bottom out. And then they both kind of took off here starting the 27th is when the equity market started to take off. And then here on November the 1st is when the bond market started to take off. And it's had a really good 2.5 months to get up to. In fact, if you look at the weekly, again, the weekly version of this, if I were to go rate of change and go to TLT and then go out to the 20-year weekly chart, and you can see it's been a 1, 2, 3, 4, 5, 6, 7, 8 weeks. Over the past 8 weeks, TLT is up 16 and a third percent. So if I were to zoom out to kind of give you an idea of how big of a move that is, it's bigger than what we saw in November. It's about as big as what we saw in COVID, and then again the credit crisis, and then again the washout phase of. I mean, this is extreme demand for long-term bonds, and it's like what drives such extreme demand for long-term bonds over a short amount of time? Well, previously it was like full-on economic distress. Again, COVID shutdowns, credit crisis, and the washout, the worst of the worst, the washout phase of that bear market there. Those are the only periods where we've had an 8-week surge in demand for long-term bonds. And as a result of that surge in demand, the 10-year yield, let's get back to this chart here, the 10-year yield has dropped all the way to 4%. So today we actually did hit 4.009, so right just under 4.101%, finishing the day at 4.03%. Big drop from 5% that we had in October now to the 200-day moving average of the yield. What's interesting, though, is when you look at like the short-term yield, the 3-month especially, the 3-month actually rose today. This is the effective Fed funds rate. So when you look at the spread between, well, here, that's the 2-year. If you look at the spread between the 10-year and the 3-month, getting down to, 140 basis points now, like that's an extremely low level and still hasn't crossed above zero. So at some point in time, this will cross above zero, and that's when the recessionary expectations really start to ramp up. And what will cause it to ramp up above zero will be that the Fed will start cutting rates, right? That's what will eventually get this. And again, it's not until, especially the 2-year, the 10-year, when this spread, it's not until the spread gets up to 100 basis points or higher, back up to 100 basis points or higher, is when you start to worry about it. So when you get up to 100 basis points, except for this early 80s recession where we were in recession, again, that was kind of that high inflationary period. Every other period, by the time you got to 100 basis points is when you started the recession. So the fact that people are saying whether or not like this is a soft landing or we've avoided recession with the yield curve still negative is a little premature, because you can't, I mean, like again, in 94, 95, we never went negative during that. The last rate hike got us down to 15 basis points, but never did get negative. Of course, we were as negative now as we've ever been, right? Down over here in the late 70s, early 80s. So big difference between what actually was a soft landing, where the market was pricing that in, versus this now. So again, not until, and we never did, notice, get back to 100 basis points in the 90s on the yield spread. Will this get back to 100 basis points? Considering how negative it's been, it's more likely, since that never did get negative, hence why it never did get up. And real GDP was very strong. Velocity of money was negative. So we didn't really have, velocity of money was negative actually over here in the 2000s. It was pretty strong here, but the real GDP was really strong, and that helped keep inflation down. So you were able to keep a yield spread here. Very different scenario now, where velocity of money has grown from a year-over-year rate at the fastest rate ever on recorded. Money supply, when you look at the money supply, it's interesting. We talk about how money supply has been declining. Well, when you look at it on a quarter-over-quarter basis here, money supply actually rose in the third quarter. So that's not talked about a lot. But we had a few 4 quarters in a row where money supply decreased, though not nearly to the same extent that it increased for multiple years before that. So we had a brief period, and you notice we don't ever have periods. Like, there were rarely quarters that we ever have any decreases. In 93, here in 2003, and then in 2010. I mean, those are brief 1 quarters, and they're barely negative. So the fact that we were negative at all is a big deal. But we have to keep in mind, again, all the quarters that we had, including a 13% gain in the money supply. See, we haven't had that since 83 was the last time we had even a 5% gain in a single quarter. And we had a 13% gain followed by a 4% gain followed by a almost 3, and then 3.5, and then a 3.83, and then a couple 2%. So, and you can see 2.5% is a pretty strong number by itself. We had multiple quarters of 2.5% or more. So the fact that we had a 1.5% is not that big of a drop, and the fact that we don't ever drop, and when we do drop, we go right back to positive levels. So it's going back to positive levels at the same time that your change in the ratio has gone up. Again, the biggest change that we've ever seen after the biggest drop, right? COVID shutdown, nobody changed hands. Usually, you can see you're at the depths of a recession when money supply is changing at such a negative rate year over year. Because again, the velocity is that money changing hands, and that's what causes this to come back down. So if this stays high and money supply grows, then that means in order to avoid inflation in the future, we have to have, and I don't think I have that on here, but we have to have real GDP. Let's see if I have that. I don't have it on here. No, so I need to add that back in here. Real GDP, because I did have that here at one point. That's the other component, right? The velocity of money and the growth in the money supply is a function. Is those two combined make up nominal GDP? So that would be the real GDP with its price inflator, and you can see on a quarter-over-quarter basis, we had a pretty decent 3% gain in real GDP in the third quarter, which is the highest we've seen in a while. And we had some really high there, and when we started with the inflation, right, we had 12% in one quarter real GDP on a change, right, percent change from a year ago. Of course, when you just look at the quarter-over-quarter by itself, we had a 7.75% gain in real GDP in the third quarter of 2020, and then it dropped down and now currently at 1.26%. Again, that's not strong enough to offset that with a positive growth in money supply. So that, that's why there's a good chance that inflation won't be transitory, right? Again, unless we get it, again, like the late 90s, where we had 5% or near 5% gains quarter after quarter after quarter on a year-over-year basis for multiple years. And that's what helped us avoid, despite strong velocity in money, or at least positive velocity in money in the 90s, that's what helped us avoid inflation, is that real GDP stayed strong. Over here in the 2010s, we had negative velocity, and that helped us avoid inflation. Now we don't have negative velocity. It's back to being positive. Money supply is growing. Real GDP is not, especially not expected in the next quarter in Q4 to grow as much. So we'll see kind of what impact that ends up having going into 2024 as to whether or not this velocity. You can see when we get high, it doesn't really stay very high. The year-over-year change really starts to come back down, and that usually is associated with the gray shaded areas on the chart here, including the biggest one there with the shortest recession that we had. If you take a look at the sector moves, let's take a look at the sector moves here today. You can kind of see which sectors benefited the most from today's news. So let me zoom into just today, December the 13th. You can see utilities and real estate were your biggest movers, along with staples. So now, again, and healthcare, your four safety areas were your biggest gainers today. Now, granted, they're also interest rate sensitive, right? They are the most interest rate sensitive areas out of all of them, but they are your safety sectors. So two of your biggest safety areas were your biggest winners. Of course, they've been lagging since this whole thing started back on October the 27th is when we bought them. So going forward from the 27th into now, they've been laggards, right? There's staples, there's real estate actually has been matching everything else, but there's staples, there's healthcare, and there's utilities. So they've been lagging behind. They started to ramp up, 12% gain now in utilities over the past 3 months. And then you can see real estate up over 20%, and not even 3 months, well, however many, 30 days, 32 days since we bottomed out there. But you can see technology, discretionary, communication services didn't bounce nearly as much. When you look at the 12 grid for the main sectors, you can see kind of, the 3 month returns, 12% for XLK, 2% for XLY, 5% for XLC. You can see small single digits except for energy. Energy ramped up today, but not nearly as much. There's your cluster on utilities. There's your big sharp move and all this. I mean, look and see all the safety. We're all dark green shading and green line, but today you can see a big move, big time move out of nowhere on all these sectors, all hitting 3 month highs. Staples didn't quite hit 3 month highs, but everything else did, and getting positive returns now. Staples is now not negative. It's now only the energy sector that has a negative 3 month return. All right, well, that brings us to our trade idea of the day. I want to take a look at Merck. Let's pull up Merck. Unlike Pfizer, which dropped pretty significantly, Merck actually rallied and closed above its highs of the past few months. Strong short-term sentiment crossing above the intermediate line, almost 4% above the 30-day moving average. Dark green shading and a green line up there, so that's a positive development. You can see the weekly chart is bullish. You can't really see it as well there. You can see we're almost above, Hakinashi close is almost above the 40-week moving average. We are clearly above the 10-week. We got the green arrow there. Bullish candle, rising PPO. Even though it's negative, it's rising. Strong candle, size of the candle there. Looking at the three green arrow charts, we do have 3 green arrows. The stochastics turned back up. The MACD is turned back up. and then obviously you're above the moving average with a pretty decent amount of volume here today. A little bit of a breakout kind of a day. The positive DMI crossed above 30. The negative is that close to crossing below 20, which means the ADX is rising down there. The RSI and the CCI jumped up to strong levels above 60, still above 0, above positive 100 down there. From the Ichimoku cloud, you can see we actually closed above the cloud and without even a trend starting yet. And then finally, when you look at the Bollinger Bands and the Keltner channels, you can see we are up above the upper, or at least we're really close to the upper band, and that close to being above the Keltner channel. In fact, we actually did close above the Keltner channel, and the bands themselves broke out yesterday of the Keltner channels, are moving out to the outside. So good strong move for the stock as we are starting to make our way up to the upside. So what I decided to do on this one is to do a bull put spread. We'll look at selling the 105, buying the 100, trying to get to that $1.16. If we can try to get up to $1.16, it was at $1.16 earlier, so you'd have to set kind of a limit order here of $1.16 with a limit in GTC, and we'll set that up for a full contract size. You can see our break even here. Let's just go ahead and send this through. You can see our break even on this right there is below today's move, so we'd have to completely reverse today's breakout move to the downside if we're going to if this is going to break out. And of course at that point, again, we're trying to make $348. We'd be willing to take that loss. If it got down, it'd have to get down to 348. We'd have to get down to the 102 area, so we'd have to kind of break through this and then down some more into this spot before we take. And at that point, of course, we would obviously be back below moving averages. We probably wouldn't be in this stock with how fast things are rising. You'd be back below all the 30, the 50, everything. I'd be back below the moving averages by the time, so we wouldn't want to be in it anymore and be willing to take that loss if that were the case. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.